So before we begin, thank you so much for taking the time. Today, we're going to go through a crash course in which we're going to solve about 12 to 16 questions. I'm going to ask you to participate. It's going to be really, hopefully, as engaging as possible. And at the same time, we're going to try to just break down the theory. Now, before we begin, I just want to give you a better perspective of what Com308 is going to be like, and also what your exam on Friday or Sunday will be like. So, as most of you know, the first exam was on 15, if I'm not mistaken. The average was around 30 to 40%. But I don't want that to be something that stresses you out. Because the second exam, which will be on Friday or Sunday, is much more theoretical. It's much more stuff that you could grasp and understand, and it relates to like math that we learned back in in high school. But what's cool is that on average, the second exam has a average of about 70 to 75%. So as you can see, there's a big jump between the first exam and the second exam. So already, on average, you are expected to do much better on this exam, and that's without any curves whatsoever. So really come in this Friday with your confidence really, really high, and you should expect to do well. All right. So that's already something super duper like chill. Now, as you know, most of your questions will be focused on chapter 8 and chapter 9. So essentially, the good old portfolio theory and this idea of risk and return, and then CAPM. This is where you're going to get about 75% of your question, 60 to 75% of your questions. Then another large portion, well, about two questions per chapter, will be dedicated to market efficiency. And then two other questions will be dedicated to options. All right. And today we're going to spend some time at the very end to understand what market efficiency is all about, and then also understand how to solve option questions in a really simple and straightforward way. Essentially, this whole idea of the payoff diagram. And I understand that none of us want to spend some time on that when we're studying because it's such an exotic concept. But today we're going to try to make sense of this. Now, before we begin, I have 2 more minutes to spiel on, is that the reason why the average is 70 to 75% is because the exam 2 is just straight up more simple. It's not as crazy. It doesn't really rely on wording as much. It's very straightforward, regardless of your background. But I think that exam 2 is an amazing opportunity for all of you to get much more than the average, because it's an opportunity for you to lever all of the different resources that I have available for you. I know I'm super annoying on Facebook and on the groups and all that good stuff, but that's because there's honestly a lot of different type of resources available such that you're able to learn at your own pace and learn in a way that's more effective for you. So as you saw, you have the mock exam that we're going to be doing today. Okay. You have the YouTube videos that I have on my channel. And there are about 18 videos just on exam 2. Okay. Then there are all my practice problems. And there's about 70 pages, I believe, or 50 pages. And then you also have my visual notes, plus my step-by-steps. So essentially, what I'm trying to say here is that you have 5 different ways, actually 6 different ways, if you include my notes, to understand the material, to master this material. So there should be no reason, if you go through all of that and you spend the time necessary, for you not to do amazing. And that's something that I really, really, really want to stress, that you have everything available. So before we begin, does anybody have questions or maybe clarifications, or are we good? I'm going to assume that we are chilling. Okay. So how I like to do this is I like to.
You had a question?
Yeah, what's up?
I was wondering, where can we find access to your 50+ practice problem?
They're on Casa JMSB. I'll put them in the chat, but they're on Casa JMSB. They're right here, the practice problems. I put them into the chat, and yeah, they're right there, and you can use them to your advantage and learn.
Thank you.
I'm a pro. Okay, so with that said, you guys could still see me, I'm assuming. So let's begin and let's try to get a sense of what question one is all about. How we're going to do this is that I'm going to read the question with you. I'm going to highlight information that's valuable, and then I'm going to ask you to actually solve it for in like a minute or two. And from there, we're going to just break down the question together. All right. So an investor invests $800 in a risky asset, okay, with an expected rate of return of 18% and a standard deviation of 25%. The investor also invests $200 in a treasury bill with 4% rate of return. All right. Her portfolio's expected rate of return and standard deviation are what? Okay, so we're seeking the portfolio return and the portfolio risk. Okay, now before we begin, I just want to clarify a few elements. All right, here we're looking for ERP, and here we are looking for risk of portfolio. This is our risk-free, which is at 4%. All right, and then we have our expected return, or we call it, the risky asset or just stock A at 18%. All right, and then as well, the risk for the risky asset is 25%. Now with that, I'm gonna give y'all 2 minutes to try it out. You know, it's always easy if somebody does it for you, but I want you to test it out and see how you feel. So you'll have 2 minutes to give this a shot. And if you have questions within that 2 minutes, by all means, ask me. I think this is the best way to understand the material. So 2 minutes, we have 1 minute and 40 seconds left. At the same time, I'm gonna essentially just write a few notes to kind of give you some hints within that 2 minutes. We got one answer. We still got 40 seconds left. We got one answer by Yara. It could be correct. It could be C. We don't know yet, but we got one correct. We got one essentially answer in the chat. We got another one. We got Evan with C. Maybe we'll wait another 30 seconds for everybody to give it a shot. We got Alexander with C as well. Okay. All right. Now we got essentially 3 answers at C. All right. We got 3 answers at C. Now, it's good to know. It's good to know that y'all are pros because yes, the answer here is definitely C. Okay. Now, how do we go about this? For those of you who weren't able to answer, who weren't able to do so in the right time, is essentially before we begin, as you can see on the screen, we want to be able to identify the weight associated to essentially the risky asset, which we'll call A, and the weight associated to RF, right? These two are synonymous, okay? So the risk-free rate. So quickly, we realize that 0.8 is associated to the risky asset and 0.2 is associated to the risk-free. Now with that, we already know that if we want to calculate the expected return of our portfolio, we just have to do a simple formula, okay? So we'll use, in this case, purple. So to find the expected rate of return for a portfolio, all that you have to do is do weight A times ERA plus weight B times ERB. Now that gives you the following. If we want to simplify it as this. Now in this case, weight for B would be the weight of RF, the risk-free rate. And then the ER would be RF. So in this case, we'll have the following: 0.8 times 18% plus 0.2 times 0.04. And that would give us the following: ERP equal to 15.2%. So that's the first step. The first step is finding the expected rate of return of the portfolio. The reason why we want to find the expected rate of return of the portfolio, it's because that's the easiest thing. It's a very simple calculation with little to no nuance. So already, once we found 15.2%, we know for sure that A is incorrect, and we know for sure that B is incorrect. Now, all that we have is C and D that's left. Already, you can make an educated guess if you forget, how to find the risk of our portfolio. All right, so that's the first element. Then, what you could do to find the risk of our portfolio, okay? The risk of our portfolio when we invest in the risky asset NRF. And now, before we continue, can I ask somebody in the chat, or you can raise your voice, what is the risk of the risk-free asset? What is the risk of the risk-free asset?
0.
Alexander, 0. And Evan says the same thing as well. Obviously, if we have a risk-free asset, there's no risk. So when we consider a scenario where we are investing in two assets, all that we have to do is do the following. So the risk of the portfolio will be equal to weight of A times the risk of A. And in this case, it's as simple as this: 0.8 times 0.25. And that gives us the following: 0.2, or simply 20%. And for that reason, C is the correct answer, and this would not make sense. Okay? It's as simple as that. Now, is everybody okay with this? This is the first question. The other questions will not be as easy, but this is still something that you're probably like 90% sure to see on your exam. So it's important to know how to do this in like 20 seconds, 40 seconds, a minute, right? Are we all okay with this? Perfect.
Oh, yes.
Perfect. Okay, good. Amazing. Happy to hear that. So this is how you'd go with a typical question like that. Now, something else that we may see on the exam, and I'm going to zoom out for you to see, is that I often see multiple choices that are based on theory, and especially related to chapter 8 and or chapter 9. And it's really, really important for you to be able to identify the nuance within these theory questions and answer them on the fly. So on question 2, we have a bunch of different prompts, okay? And we're going to try to see if they are true or false. And at the same time, we're going to add some theory like explanations to it, okay? And by the way, if you want to have the breakdown for these specific questions, like step by step by step, I actually have 2 documents that are all posted on CASA JMSB that explain, for example, CAPM graph intuition, the efficient frontier, the trade-off between risk as we change weights. All of these things are broken down into these documents, and there are also YouTube videos for free, literally out there for you, that explain this for like 20 minutes. So everything's out there for you to master this, okay? Just want to make that super clear. So, as I said, we're going to look at each of these statements, and we're going to say true or false. All right, let's read them together. So, when two yeah, it's quick. Okay, when 2 risky securities with a correlation of less than 1, all right, the portfolio standard deviation will be less, okay, will be less than the weighted average of the individual securities, okay? So really quickly, what do you guys think the answer is here? Are we looking at something that's true? Are we looking at something that's false? We got Alexander saying true. We got Yara saying true. What do y'all think? We got Raquel saying true. Okay, yes, amazing. The answer here is definitely true. And I'll give you the explanation still because it's such an important one. So when we look at COM308 and when we look at the trade-off between risk as we diversify, we want to look at this idea of correlation. And correlation is an amazing measure to identify the actual consequence of diversification for our portfolio. And the best way to really plot this out is through the following graph, right? And it's something that you've seen in your manual, it's something that you've seen in class. And essentially, we're going to call our horizontal axis the weight placed in a stock A. And we're going to look at our vertical axis as risk. Okay. Now, what we can notice here is that we could plot 3 different lines as follows. Okay. Just gonna draw them out for you. We have 3 different lines within the structure. Okay. And what's really cool here is that when you take some time to look at this, you get to notice that this first line, okay, the first line that we have in purple is what we call a scenario in which the correlation is equal to P1, okay? So correlation is equal to 1. But then when you notice here is that if we look at our blue line, this is what happens when our correlation is actually equal to 0, in a sense, less than 1, all right? Then if we look at the following line in green, we have a scenario where the correlation is equal to -1. And the takeaway here is that anything that's underneath 1, okay, anything that's underneath the purple line, so in blue, will give you a scenario in which when you add 2 different securities, when you diversify your portfolio with securities that have a correlation less than 1, you will for sure have a portfolio that has risk that is lesser than those individual securities, okay? Let me say this one more time. And this graph identifies that for you. So when you invest into 2 different securities with a correlation less than 1, no matter what, the risk of your portfolio will always be less than that of the 2 individual securities, okay? So that's exactly what we wanted to portray. Now, before I continue, this is something that's super important. And on the exam, they may not say it in the same words that you saw in A. They may say in a different sense. So are we all okay with this idea of correlation? Can you say yes in the chat or no in the chat? And I could expand.
Okay, I just want to make sure I understand, right? So we're saying that for anything where the correlation is less than 1, when you diversify with 2 securities with the correlation of less than 1, then the overall portfolio risk is less than the individual risk because they go in opposite directions, so they cover you, whether the market goes up or down.
Exactly. That's one way to look at it, and it's a really good sense. So you guys understand this. This is really good. All right. So with that in mind, let's move to the next question. Okay. And this one says, and I want you to tell me what you think it is, that there is no benefit. Okay. There is no benefit from diversification if the correlation coefficient is equal to 0. What is the answer here? Is it true or is it false? There is no benefit from diversification if the correlation coefficient is 0. Alexander says true. Yara says true. Okay. Evan says false. One more person to give an answer. Then I'll give you what's up. What do you think? Huh? We have 2 trues and we have 1 false. Evan is going on. Okay. What about you, Monica? What do you think is the answer? True. Okay. But I don't. Okay, amazing. This is really good because this is an opportunity. I'm really pumped. This is an opportunity for y'all to really understand the idea between the correlation coefficient, okay? The answer here is false. And let me tell you why it's false. All right. So what I will do is I'm just going to copy our little, if I could copy it, I guess I can't. Let me see. Perfect. Okay, so I'm just going to copy our little graph that we made and make it smaller such that we could expand on that. All right. So can we all agree that we have our correlation table right here? Can we all agree that this is our correlation graph And this is how we're going to be able to find our insights. Are we okay with that? Quickly, yes in the chat. Amazing. Okay. So what I want to explain here, all right, really quickly, is that weight A is associated to security A, so stock A, okay? And then weight B is associated to security B. I think that makes sense, all right? And just to be super, super annoying, I'll give you guys an example. So this could be Apple, and this could be like Adobe, all right? We have two different stocks, Apple and Adobe, all right? The security A is called Apple, security B is called Adobe, okay? And right here, we have the weight attributed to security A. In other words, we have the weight attributed to Apple, okay? So if we are invested over here, that means that 100% of our money is put into Apple, okay? But if we are here, that means that 100% of our money is attributed to Adobe. Adobe. And if we're here, let's say, that means that 50% in both. All right? This is something that I really want you to understand. Okay? So with that said, I'm going to do this step by step. If we're at the point right here, okay, this just means that 100% of our money was pulled into one specific stock, the stock of Adobe, okay? Such that if we know that the risk of Adobe, okay, is equal to, call it, I don't know, 8%, and that we know that the risk of Apple is equal to 15%, can you tell me what's the risk here at this specific point? Can somebody tell me in the chat what's the risk here? Just for fun. All of our money is put into Adobe. What is the risk if we're at this specific point?
0.
It's 8. It's 8. Amazing, Raquel. Amazing, Alexander. If all of our money is put into Adobe, then, of course, our risk will be 8%. Okay? And then just to double down, if we're here, what is our risk? 15 more. Can I see some more answers in the chat? Okay. We have 15%. All right. So let me just write this down. 8%, 15%. Okay. So the idea is that if the correlation coefficient is equal to 1, as we diversify our portfolio, we're never really making any benefits if we lie on the purple line. But if the correlation coefficient is less than 1, we know that we get to a point right here, okay, or anywhere that will be smaller than 8 or 15%. Okay, such that if we diversify, maybe we could get to a point where the risk is equal to 6%. All right, if the correlation coefficient is equal to 0. All right, that's amazing. So from that sense, we know that if we diversify, we're able to reduce our risk. And can we say that that's a benefit to us? That means that we're able to reduce the risk of us losing money. Does that make sense to us? Really quickly in the chat. Okay, we have a yes. We have one yes. So we have another yes. So what I'm going to ask you is, what was not clear here? What are your questions? And I could answer them from a different perspective.
I have a question. Sorry. Because I wrote here that investing in stocks with positive correlation increases risk. Like 0 is not positive?
Like, no, the idea is that a positive correlation, by the way, is the correlation coefficient could typically not be above 1. 1 would be the absolute value, okay? And that's the difference between covariance and correlation. Covariance could be any value that's positive, whereas correlation has a maximum value of 1 to a minimum value of -1, okay? Does that make sense?
Yeah.
I'll write this down for you because I want you to have this in your notes. Everybody, this is really important.
Thank you.
Correlation, okay? Its domain is -1 to 1. Covariance, and this is why I'll tell you in a bit, could be minus infinity to infinity, such that in the book and in your notes, when they say that covariance is not an empirical or an absolute measure of essentially risk, is because the value you get could be anything from -6 to minus infinity, and it could be anything from +5 to +1,000,000. So it's really hard to measure how effective that is. But with correlation, we know that whatever is going to come out, the return, the output, will be anything from -1 to 1. Okay? So if our correlation is 1, that means that there's literally no benefit. That's the absolute scenario. But if our correlation is like equal to, call it 0.5, well, we know we're going to be at a point here where we're going to be able to essentially get a benefit from diversification. Okay, so that's the difference between covariance and correlation. Does that make sense?
Could you repeat the last two sentences you said?
Yeah, go on.
About the difference between covariance and correlation.
Yeah, perfect. No worries. I'll say this one more time. And this is something that I saw in my exam. And it's like covariance, all right, is not an absolute measure, whereas correlation is, because it is bounded to -1 as a case in which there is absolute diversification benefits, and it's bounded to 1 in which there's no benefits to diversification. Okay. So in this case, the clear takeaway is that 0, a correlation coefficient of 0, has a lot of benefits for us because we're able to find a point, as you can see here at 6%, that our portfolio risk is smaller than security A and smaller than security B. So to make this clearer once again, essentially, we're saying that 6% is smaller than, in this case, 15%, and 6% is smaller than 8%. Yeah, exactly. That's amazing. Anything that has a correlation coefficient less than 1 technically has a benefit in terms of diversification. Okay, that's really important. I'm gonna say that once again. Anything that has a correlation coefficient less than 1 has a marginal benefit in terms of diversification because we'll be having less risk. All right. This is a good question because it really does test your understanding of what this element called correlation coefficient is all about. All right. So let me.
And just... 0 is the most beneficial. Correlation is 0.
-1 is the most. -1, by the way, everybody, this is super important. If you see this on your exam, you need to notice. All right. -1, you literally have risk equals 0. All right. At the correlation coefficient, there's a point at which you could get risk equal to 0%, risk equal to something else. So it's much, much more valuable. If you could have securities that are negatively correlated, God bless you. Can you send them to me, please? Okay. So that's the best case scenario. All right. So with that said, let's move on to the following question. I'm going to zoom out if I can, if it lets me. There you go. So with that said, standard deviation measures market risk, okay? Whereas beta measures unique risk of a portfolio. Can you tell me if this is true or false? We got one false. We got one false. What is the answer? We got another false. I need one more answer. False. Amazing. Yes. Here, the answer is definitely false. Okay. There's just no other way to go about it. All right. And once again, we know that beta measures market risk. And we know that beta looks at systematic risk, okay? You could also call this non-diversifiable risk. I'm just giving you all the buzzwords that you need to understand and remember when looking at anything related to beta, all right? Now, when we look at the standard deviation or variance, either or, we're looking at the risk of a specific security or portfolio. Okay, is that clear for everybody? Makes sense? We can move on. I'm going to assume the answer here is a big yes. Amazing. So now we're going back to this idea of benefit. There is no benefit from diversification if the correlation coefficient is 1. Now, what is the answer here? Okay, we got 2 answers. I need 2 more. We got 1. I need 1 more. Amazing. Good. Pros. Yes. So now you understand what we meant. So the answer here is true. Amazing. There's no benefit. All right. All portfolios on the efficient frontier have the same variance to return ratio. All portfolios on the efficient frontier have the same variance to return ratio. Fake news. We have 2 falses. Okay. I need 2 more answers. 2 more answers. We got 2 false. It could be right. It could be wrong. I don't know. We got another false. I need 1 more. 1 more. Need 1 more true or false in the chat. And then we'll move on. And I'll tell you why. I mean, anyways. Okay, amazing. Good. So yeah, the answer here is blatant. It's obviously false. The reason why this is false, and it relates back to what we've discussed. When we look at when we're looking at elements for exam 2, we're typically looking at graphs. And this is something that you're going to see happen in your other financial courses, in your major courses and stuff of that nature. You always want to look at the relationship of essentially your risk to return, right? And we know that we could look at our efficient frontier as follows. And it's very obvious to us that every single point that we choose will all have a different return to risk profile, such that it would make no sense that when we do risk to return, that we would have the same values on our efficient frontier. Just there, we know that that's impossible. But also, when we study the theory for the efficient frontier, there's this idea of our minimum variance frontier, right? Our optimal element. And just from there, we know that it's impossible for them to all have the same variance to return, because there's a point at which we have the optimal point of variance and return. So these are a bunch of different cues that you could use to be able to understand the efficient frontier and these type of problems. So yes, here it's false. There's just no other way to go about it. Let me just zoom out a little bit. So the minimum variance portfolio represents the lowest level of variance that an efficient portfolio can have. Okay, the minimum variance portfolio, the MVP, represents the lowest level of variance that an efficient frontier can have. We have 1 true in the chat. We have 2. I'll go for 1 more. Just 1 more answer in the chat, and then we'll move on. Exactly. Yeah. The answer here is it's obvious. The answer here is definitely true. And I just said it right here. This point is the point at which we have the least risk. And for that case, the answer here is a clear true. What's up, man? Yeah.
All right. So 2 things. First off, the graphs we use, will it always be return in the y-axis or risk in the x-axis, or can it be inverted sometimes to mess with us?
No, always the same. Always the same. And I'll give you a really good example for why it's always the same. Check this out. So if you do this, right, our minimum variance portfolio, the reason why it's like that is because we know that this point is a point where risk is the lowest. If we did it, that's why risk has to be on our x-axis. But if we did it the other way, we would have a different type of graph. We would have a graph that would look essentially, if I'm not mistaken, if risk is here, it would be, if I could think, it would be like this, something like that. So our graph would look totally different. It wouldn't be the same thing. And that would not be our minimum variance portfolio anymore. It wouldn't be an efficient frontier anymore. It wouldn't hold the same weight. So on the exam, it would always look like this, no matter what.
Is that-
Okay.
That's, I see for the CML and the SML. Are there other subjects that we encounter which might invert the axes for any reason?
No,
And
no.
okay. And
No.
on that note, the minimum variance portfolio, this is linked to the chapter 9 material.
Chapter 8 and 9. Chapter 8 and 9, more chapter 8 than chapter 9. It's honestly something that you're probably only going to see, by the way, everybody. You're only going to see this idea typically of efficient frontier when we discuss theory questions on the exam. So you may see this in 1 to 2 theory questions where they may allude to this idea of the minimum variance portfolio and the efficient frontier. So it's not so much a mathematical question, but much more a theoretical question that you'll see on the exam.
Okay, and the efficient frontier, what's the tangent frontier again? The tangent.
That will get on later on, okay? I'll show you.
But is it connected to the efficient frontier and the minimum variance portfolio?
Yeah, 100%, 100%. So you'll see exactly what I mean. So let's move on to G. So all portfolios, all right, all portfolios on the efficient frontier, all right, are attainable. Now this one is an interesting question. All portfolios on the efficient frontier are attainable. This one's definitely an interesting question because, and that's why I take the time to show it. And I just want to take the time to show it because there is a room for argument. The answer clearly would be that it should be false, right? That it should be false in the sense that there's a point at which, right? There's a point right here where these portfolios look interesting for us. But there's also a point here where the portfolios just wouldn't make sense because you could have this portfolio here that has the same essentially risk, but it has a different return basis, as you can see. So for that reason, you would say it's not an efficient portfolio to take. But the reason why I'm showing this is because on an exam, they had this question and they put it as true, okay? It's really, 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 really weird. But the only reason why I'm showing you this is because on an exam, they put this as true, all right? And this was an exam that I had and I was very surprised. But in our logical sense, and when you look at this with profs, the answer typically would be false. But why I'm showing this right now, and I can't give you an explanation, I just want to give you like some red flags if you see this on the exam, that they put this as true. I think it's extremely whack in my opinion as well, but I've seen this on an exam and I've seen this as true. Maybe it was a typo then, but still just putting that as a red flag such that there is some room for argument if you ever have that on the exam. I did not have that on mine, but I did see this in the past. So just quickly showing you guys this because it is kind of ambiguous in how they've decided to go about it at JMSB. All right. So I just quickly wanted to show that to you guys. What's up?
Do they claim it as true because you could still attain those portfolios even though they aren't efficient?
That's exactly it. That's the point. Like they aren't unattainable. They're still definitely available to you because they are within the efficient frontier, within all the mixes of different adjustments for portfolios, but they just aren't logical ones. So that's why it's kind of an ambiguous answer on their end.
Okay, so technically the answer is like yes, like it's true.
Yeah, like it's iffy. I'm not gonna lie, it's iffy. That's why I just wanted to show it. I'm not the. I'm just giving you the message here in that case.
Thank you.
Perfect, no problem. What's up, Evan?
Forgive me, that when you told me that the intuitive thing would be that it's false, that also really took me aback because I always assumed it was automatically true. Like in the textbook, when they talk about that, they say everything that's on the efficient frontier line is attainable. It's not necessarily the best deal. It's not necessarily maximum efficient with everything that we can get. But I always thought like it came intuitively that like I thought it was obvious that it should be, but apparently like I don't understand why it would be non-intuitive to think. I don't understand why we could think that the answer to that question was false. I'm surprised that the first instinct for people would be like, why would people think it's false? It's just why I don't understand.
Yeah, 100%. And I don't want to spend too much time on this, but what Raquel said, what Evan said is definitely a good perspective, because technically the efficient frontier, right now we're more having a discussion, but the efficient frontier really represents all the feasible portfolios out there, right? Out of all the different portfolios available, the efficient frontier represents the feasible portfolios. So in that vein, we can say that they're attainable, right? But at the same time, some could argue that we would only look at those that are above the MVP, above this point. So I definitely get that. So for that reason, though, on the exam, they did place this as true. So if you see this on the exam, I would say maybe put it as true because that's what we've seen in the past. Now, with that said, let's move on to the next question because I want to just cover a little bit more stuff. So this one's a little bit more equipped, if you would say. So we have two risky securities with a correlation less than 1. All right, we've seen this a lot at this point. So two securities with a correlation less than 1. When they're held in a portfolio, what does this mean for us? Can it be A, B, C, D, or E? What is the answer here? What do you think? A, B, C, D, and E. Okay, y'all understand what you're doing. Amazing. I'm happy to see that. Yes, the answer here is definitely B. And the really important nuance here is that the portfolio standard deviation, okay, so this will be less than the weighted average, and we've seen this so many times at this point, less than the individual securities, okay? So less than OA and less than OB. Whereas the other ones are saying that's going to be greater, equal, or always equal. And B is just the best answer here because we've seen it, we've understood this based on our graph, that if the portfolio standard deviation is less than the individual securities, that means our correlation must be at least less than 1. All right. So I think this makes sense to everybody. We've done like 4 questions on this at this point. So with that, let's move on to the next question. All right. So security A has an expected return of 12%. All right. So expected return of 12%, we have essentially ERA equal to 12%. We have a standard deviation of 14%. So we have following. Security B has an ER of 10% and a standard deviation of 8%. So what I like to do is just, write down my stuff such that it's clear and easy for us to identify. The correlation between A and B is equal to 1. So the correlation is equal to 1. If you invest 20% in A and the rest in B, what is the standard deviation of your portfolio? All right. So if you know that weight A is equal to 20%, you know that weight B is equal to 1 minus 0.2, therefore 80%. What is the standard deviation of our portfolio? I'm going to give you guys 2 minutes to give this a shot. Okay, 2 minutes to give this a shot, and we'll be able to see what the answer is here. We got 2 pros with answers quick. I'm going to wait for 2 more people to give it a shot. All right, 2 more people to give it a shot. We got another D. Okay, y'all are pros. Okay, you all are pros. So I don't like spending too much time on this question, but something really important to see is you need to understand how to do this on your exam. There's no other way to go about it. Okay, so what I would do if I were you is I'll just have on my cheat sheet just these 2 formulas ready and on standby, because this is an easy point. And you never really know on the exam for what question they're going to give you an easy point. And you might as well just take them when you see them. All right. So I'll give you the formula really quickly and how I would go about it quick. So we would have weight A times as follows. And then you just plug all of this in. You could use, I mean, essentially you would just do weight A times weight A times standard deviation of A, both of them squared plus that. But you could use a formula that works best for you. Me, this one's just so quick. I just plug it into my calculator. But if you have a simpler formula, definitely go for it. This is just one of those questions where it's so simple. So you just want to be able to remember what formulas work best for you and what approaches works best for you. And that's the easiest way to go about it. Other than that, it's pretty straightforward. I don't like spending too much time on this question. It's one of those easier ones and you were able to find it fairly quickly. So yes, the answer here is D. With that said, this one's a fun one. This one you need to understand how to do it, and it's pretty interesting. You will definitely see this on your exam too, or on your final. This is something that I've seen twice on my exams, this idea of finding our answers here. And
I'm sorry, could you go up to that one really briefly, please?
yeah, what's up? You could
Okay.
just formula, and then you could essentially trade off this fairly quickly.
And if, right, because since it's the COVID is the covariance of A and B is just 1, we could just discard that entirely and do +2 times the WA and WPB, right?
Times OA, OB, exactly.
Times OA, OB.
Yeah.
Right. I see, yes.
Essentially, PAB would be 1 because the correlation between A and B is 1. So essentially, by the way, I saw your question in the chat. Because we know that the correlation between A and B is 1, we could just put PAB as 1. All right. And then essentially, you would just multiply these two together, multiply these two together, and multiply these two. Okay, perfect. Amazing. So now with this said, this is a really cool scenario where you need to apply probabilities to be able to find your answers here. So let's check it out together. Let's read it through. And then once again, the classic, give you some time. You can definitely start it before I'm done reading through it. So what is the risk premium for the following returns if RF is 5% and the expected return on the market is 15%? So you have a bunch of different answers here. You have a bunch of different answers. And I would say take your time. All right, take your time doing this and then tell me what you get. Don't forget that on an exam, they never give you a bunch of information for you to find it in 3 seconds. You do need to apply some sort of gymnastic here. Okay, so 2 minutes, try to find the answer. We have different probabilities. We have different returns for each probability of states. All right, we got 45 seconds left. We got 45 seconds left. We got one answer. We got one answer. We got about 20 seconds left. We got one answer. Could be right, could be wrong. I see a B, I see a D, I see an A. I'd like two more answers before we go through this together. We got B. One more answer. One more answer. Need one more answer, then we'll get it going. Miriam, what is the answer? Oh, wow. Look at that. Okay, B. Amazing. Okay, so with that said, I'll tell you what's the answer as we go through it together. Maybe you're right, maybe you're wrong. Who knows? Okay. So the first thing, though, is I'll tell you what we need to do, what absolutely has to be done, and there's just no other way to go about it. All right. So let me just zoom in. We're gonna essentially move our way here. All right. So when you see a question like this and you are given different states, such as a boom, good, recession, depression, you're given different economic states with probabilities and returns. Essentially, you want to be able to find the total expected return for this portfolio based on these different scenarios. So in order to do so, you would simply do probability times returns, and that's going to give you ER. All right, so A times B. So what we're going to do here is we're going to do the product of every single states based on their probability and their given returns to find the total expected return. So with that said, if we do 0.15 times 0.60, what will be our answer? If we do 0.15 times 0.60, amazing. So we have 0.09. If we do 0.5 times 0.2, Alex, you cannot answer again. If we do 0.5 times 0.2, okay, nice, amazing. We have 0.1. Good. All right. Then if we do 0.25 times 0.10, amazing. Well, yes. Oh yeah. And then finally, 0.10 times minus 0.30. What do we get? Somebody else can give it a shot. Amazing. Okay, so now if I ask you, what is the total? What is the total? If you add all of these up together, what is our total? Amazing. We have 0.135, which is essentially 13.5%. Okay, cool. So we have this answer. This is really cool. Now, essentially, we just have one more step to follow. And once we follow that step, we'll be able to find our answer. Now, typically, if you guys understand chapter 9, and if you've kind of taken some time to understand what this idea of risk premium is, we know that the risk premium is equal to, what is the risk premium equal to? Can somebody tell me in the chat, actually? What is the risk premium equal to? What is the risk premium equal to? Okay, perfect. We have expected return minus RF. So in this case, if we know that the expected return is equal to 13.5, and what is our risk-free rate, just for fun? Huh? What is our risk-free rate? What did the question say? Our risk-free rate was 5%. So in this case, what would be our risk premium? What would that be? What would the answer be here? 13.5 minus 5%. Our risk premium could be something really interesting. Huh? What is the answer here? 13.5 minus 5%. 13.5 minus 1. Okay, amazing. Good. So now we're at 8.5%. If we go back to our answers, we could clearly see that the answer here is A. Okay, the answer here is clearly A. Now, this is important. What's up, Raquel?
Yeah, why don't we use the expected return on the market? Like, why is that given to us?
Because they're trying to trick you. They're trying to trick you. Their expected return on the market, in this case, is ERM equal 15%. But this is really important because the expected return on the market is essentially the expected return at this date. It's the expected return now. And it's not the expected return in these 4 different scenarios, right? When we're looking at a boom in the future, when we're looking at a good like a good thing in the future, or a recession in the future, or a depression in the future, is we're assuming different states in the future, not today. And these expected returns that we have on the market will fluctuate based on all these different scenarios, all right? Such that that's why we use that instead of our 15% given in the question. A typical thing that students will do is they'll take ERM minus RF to get the market risk premium, and they'll get, 10%. But they will forget to use all these different scenarios. Like, once again, on an exam, the first logical step to have is that there's no way they're going to give you all of this and expect you not to compute something. All right, so that's super important. Amazing. Good. Oh, this is fun. This is the good stuff. Okay, so now we're going to go do the same gymnastic. Okay, we're going to do this, and we're going to do this like as we did in the past. All these different types of questions. It's going to take us like 20 minutes. Then I understand it's a lot of information. You could take a 10-minute break, and we're going to come back to do some chapter 9, chapter 10, and chapter 12 questions, if I'm not mistaken. Okay, so this is the last little, bump before you get to chill, go pee, go drink some water, get some coffee, whatever works for you. Okay, so let's keep on the good energy. All right, so same idea. We need to match these answers to true or false. So the greater the intercept of the security market line, the higher the risk-free rate of return. We have one true. I need another true. Okay, one more. Amazing. Yes, pros. Amazing. Hell yeah. Now, because I'm annoying, I'm still going to take the time to show it to you, because I want you to really, take the time. So when we look at the SML, okay, we're looking at beta, then we're looking at our return. We know that we could plot our line as follows, and we know that the intercept, right, will be the case at which a security with a beta of 0 is typically what we consider the risk-free rate. Okay, so if we're here, that means that the beta is equal to 0, therefore the intercept is equal to RF. There's another way for you to be able to define this is through the proof that I've added onto our computer weight chats onto Casa JMSP. But this is the simple and easy way to go about it. So the greater the intercept of the capital market line, the higher the beta of the stock. What is the answer here? What is the answer? The greater the intercept of the capital market line, the higher the beta of the stock. Well, okay, amazing. So yes, this is definitely false. Okay, this is definitely false. And here, really quickly, if we're looking at CML, it's just a different scenario of the capital allocation line. Okay, such that if we know we're dealing with the capital allocation line, we're looking at risk. Okay, there's no way we're looking at beta. So already there, that there's no way. Like, beta is such a big call. Like, there's no way we're looking at beta. Okay, if we're looking at the CML or the CAL. For that reason, the answer here is false. You guys are pros, okay? You guys are doing amazing. Everybody here is doing great. So under CAPM, when the beta of a security is equal to 1, the expected return of the security is the return of the market portfolio. All right, under CAPM, when the beta of a security is equal to 1, the expected return is equal. So we got 2 answers. I need one more. We got 2 answers. I need one more. We got 1 false. We got 1 true. Okay, no, we got a true. Okay, amazing, amazing. So yeah, the answer here is definitely true. Just for reference, this is really, it goes hand in hand with our perspectives of the SML. And I'm an annoying guy, so I'm still going to take the opportunity to draw the graph. It's better now than on the exam that you're pointed with a graph. So just for good measure, we know that if we're at beta 1, all right, this is a terrible drawing, but bear with me. if beta equals 1, we're at a point where ERM is equal to essentially ERP. Okay, so this is just something that you want to be able to understand. Just fairly crucial when we're dealing with stuff related to the SML, the security market line. Okay, so under CAPM, when the beta of a security is equal to 0, the security has no risk. I'm curious to see what you're going to say here. What is the answer? Under CAPM, when the beta of a security is equal to 0, this security has no risk. What is the answer? Is it true or is it false? We have one true. We got another true. We got a false. So under CAPM, when the beta of a security is equal to 0, the security has no risk. We got false. Okay, I like this. I like this. So this is a really good question, and this is something I saw in my exam, and I made the mistake of putting on the wrong answer. Okay, I made the mistake of putting on the wrong answer, and in this case, the answer here is definitely false. Okay, the answer here is definitely false. But why is it false? Why is the answer here false? This is really important because we need to first understand beta. We need to understand what this idea of CAPM is all about. Okay. When we look at CAPM and when we look at this idea of diversification, we say that one can diversify unique risk. Okay. One could diversify unique risk, essentially unsystematic risk. All right. But one can't diversify market risk. Okay. And I'm going to go a little bit further than that. A really good example of what we could call non-diversifiable risk or market risk, or essentially systematic risk, was the pandemic. Regardless of the industry one would operate in, regardless of whoever you were affected by this idea of market risk, by the pandemic. So everybody had to deal with that. Okay, so this idea that even if you are the risk-free rate, that would not make anything to, that would do nothing to you because the pandemic and all these different elements would still exist. The whole industry would be at charge. But further than that, this idea of beta honestly really just measures to what extent a security, a stock, contributes to the variance of the market. Okay, so beta is not like an empirical, all absolute element. Beta only looks at the typical variance of the market from all of its major stocks, and then it just evaluates to what extent you contribute to the market risk. Okay, so for that reason, a beta of 0 does not mean that a security has no risk. And under CAPM, we say that market risk could never be eliminated nor diversified. So there's no such thing as something that has no risk. And for that reason, the answer here is false. Okay, so are we okay with that? Does this make sense? Do you have any questions?
I have a question.
What's up?
So let's say, yeah, they told us that in the problem that we have T-bills, should we assume directly that the beta is 0 or no?
Yes, you should.
Okay.
Yes.
All right.
T-bill beta of 0.
Okay.
Okay, and just for further reference here, a T-bill or a risk-free rate, it has no contribution to the market variance. Okay, in other words, a T-bill or risk-free rate has no contribution to the market risk. All right, just something to consider, and that's why it's equal to 0.
Okay, thank you.
Evan?
Yeah, I was under the impression that beta measured relation to market, not necessarily relation to risk. That's how I understood beta.
I'll say it one more time, just, and this is something for all of you who are going to take FINA 395 and FINA 385. Beta essentially measures to what extent a security affects the variance of the market. Okay, and here's a really good example. The market variance will affect the market's variance at 100%. And that's why beta of the market is equal to 1, okay? But a security that has a lot of risk will essentially contribute to the market risk a lot. And that's why it may have a beta of 2, 3, 4. A security that has very, very, very small risk will contribute to the market risk at a very low amount. And that's why it has a beta of 0.2, 0.3, 0.6. So that's the measure that we would want to utilize.
I'm not sure I fully understood that.
I think it's risky because of the correlation, right? The higher the correlation, then the more risky it is.
It's more of a covariance, but still, it's along that vein. What you want to know essentially here is that essentially beta of 1 means that you have the same contribution to the variance of the market. If you have a beta that's higher than 1, that means that you're risky. If you have a beta less than 1, that means that you're not so risky. And a risk-free rate has a beta of 0, but you do not need to mistake that with this idea that it has no risk whatsoever. That would be the best way to understand this.
So was I right for thinking that beta was a measure of the relation to market of security in a way, or was I really out there? Because I'm not sure. Even now, I'm not sure I fully understood the concept of beta just yet.
Honestly, and for everybody here, I'm saying this with like I'm graduating in May. You know, I did all my stuff. Like beta is that understanding of beta will definitely evolve as you take more classes. But within the scope of Comp 308, you really want to understand essentially what beta 1 means. What does beta 0 essentially entail in a sense of like, is it the risk-free rate? And that's typically all that you need to know. There's nothing more that you need to know. Beta is something that you're going to be seeing in your SML when you're going to do some math. But other than that, that's all that you need to understand. Beta evaluates market risk as well. Those are the key buzzwords that you need to understand, and that's going to allow you to answer these questions with no problem, right? And this question D, was one that was on my exam, and that was one that had different answers. For like a lot of people had different perspectives, but you want to know here that under CAPM, when the beta of a security is equal to 0, the security has no risk. Okay. Perfect. So with that being said, let's move on to the next question. Okay. The tangency portfolio is a portfolio with the lowest standard deviation. Oh, this is interesting. The tangency portfolio is a portfolio with the lowest standard deviation. We got a false. We got a false. I need one more answer. We got a false. Exactly. The answer here is definitely false. Okay. The tangency portfolio does not mean that you have the lowest standard deviation. The one that has the lowest standard deviation is what we call our MVP. Okay. And that is not the same as being the tangency portfolio. All right. The tangency portfolio technically would be right here for reference. Okay. When the expected return of stock A lies above the SML, it is overpriced. Okay. When the expected return of a stock lies above, it is overpriced. We got a bunch of false. Amazing. We got a bunch of false. The answer here is false. And one thing that I love sending to students, and once again, if you have my visual notes, this is super clear. This is super obvious. I made a literal graph for you guys that you could put into your cheat sheet that literally tells you what you could literally, the only way for you not to be able to like find the answer is if you were blind. Okay, like it literally tells you everywhere highlighted where's the answer based on the different questions they give you. It's literally out there. And essentially, what you want to know is that if this is your SML, okay, any point here, all right, and any point we'll call it here, you'll be able to understand if it is overpriced or underpriced. Okay, so essentially, if K is bigger than the market return, you could say that it's underpriced. All right. Essentially, if it's here, it is underpriced. All right. If it's here, it is overpriced, such that if the expected return lies above the SML, we would say that it's underpriced. And for that reason, this right here is what we consider no bueno. It's false. Okay. So For that reason, you understand what it is. Then obviously, if it's on the SML, you would say that it's fairly priced. All right, simple like that, easy. You just plug and play, you look at your graph and you have the answer. Okay, what's up? You have your mic open. Oh no, okay, whoops, no, just not. My bad. But now, finally, last but not least, all right, all portfolios, we'll use it. All portfolios on the efficient frontier have the same Sharpe ratio. What do y'all think is the answer here? All portfolios on the efficient frontier have the same Sharpe ratio. We got one false, we got one true. Okay, we got one false. Not sure, honestly, fair, very fair, same, false. Okay, so I'll ask for two more answers from two more different people. Okay, I need two more answers and then I'll give you guys the explanation here. Maybe I could call upon someone if they want. Tierno, what is the answer? Tierno, what is the answer? Is it false? Is it true? Put it in the chat. What do you think? But we got Monica that says false. Okay, false. Amazing. Yeah, the answer here is definitely false. Now, before we continue, something really important to understand is, well, what is the Sharpe ratio? Other than being the slope, right? The Sharpe ratio is definitely the slope of the CAL, but we can just call it as follows, okay? We can do it as follows. So ERA minus RF, okay? And essentially what we're trying to say here is that, first and foremost, if you look at your graph, right? If you look at your graph right here, whoa, that was a terrible drawing, sorry. If you look at your efficient frontier, do it like this. If we look at our efficient frontier, right, we know that every single one will have a different risk to ER. So already here, no matter where we go on our efficient frontier, or no matter where we go on our graph, our risk right here will be different, okay? And our portfolio risk, our return will be different and our portfolio risk will be different. So no matter what, the output of our Sharpe ratio will have to be different. And this relates to what we've discussed before, this idea of variance over risk, this idea of risk reward, right? Return to risk. So variance over returns or vice versa. We know that no matter what, we're going to be dealing with different perspectives, okay? And for that reason, it has to be false. There's no point on this graph that's going to yield the same output, okay? The same Sharpe ratio or the same variance over return or return over variance, okay? For that reason, this is false. So with that said, after that, we have a few other questions that I'm going to run through, and then it's going to be a lot of essentially, let me see something before we take our break. See something for y'all. Yeah, we're going to be running through a few other questions after that, but super quickly and easy. And then after that, we'll be doing some problem solving. And yeah, we're going to take a quick 10-minute break. We're going to come at 7:30 p.m. Okay, so we're going to be back at 7:30 p.m. And then we're going to jump into more questions together. All righty, so we'll get back here at 7:30 p.m. Okay, get hydrated and we'll be right back. All righty, so 7:30 p.m. All right, let's give it a shot. You know, we're gonna do more questions. It's gonna be fun. We're gonna enjoy it. And you know, as we were before, do not hesitate to ask me any questions whatsoever. I'd be literally so happy to answer them and give you my perspective on the matter. I'm just making sure my stuff is still available. There you go. Perfect. All right, so let's same idea for this set of questions. We're gonna have 11 questions. We're gonna spend a little bit less time on them so we could jump into the math stuff. But with that said, same idea, okay? Same idea. The steeper the slope of the security market line, okay? The steeper the slope of the security market line, the higher the market risk premium, okay? This one is an interesting one. We have true out there. We have a true. Okay, we have another true. Amazing. You guys are pros. Okay, so this one's true. The idea is that the steeper the slope, okay? The steeper the slope means essentially the higher it goes. Therefore, that means that the market risk premium, which is the slope of the SML, is bigger. Okay, simple, easy. You don't need to spend too much time on the theory. We know that the SML is equal to RF plus B, beta essentially, times ERM minus RF, and ERM minus RF is what we call our market risk premium. Okay, so with that said, do you have any questions? I think we're fine. And on that same vein, the steeper the slope of the capital market line, the higher the Sharpe ratio. The answer here, once again, a clear true. The same idea. Okay, the same idea is being applied. Once again, we know that the CML can be defined as being RF plus the Sharpe ratio. All right, and we understand what the Sharpe ratio is all about. ERA minus RF over OA times OP. Okay, so like that, we know the answer here is true. Now, the steeper the slope of the SML, the higher the beta of the stock. What is the answer here? True or false? Okay, y'all are always answering, so I'm gonna need 2 more people to give it a shot. True or false? True or false? What is the answer here? Okay, I got 1 more false. Amazing. Perfect, perfect. Pros. I think now, I mean, listen, it's all about repetitions. And I know this can get annoying. And I know you can be like, okay, let's get it over with. But the more you're exposed to these type of questions now in an engaging environment, will make sure that you're a pro on the exam on Friday or Sunday. All right. So the intercept of the SML is the risk-free rate. What is the answer here? Yeah, I hope you know it. The intercept of the SML is the risk-free rate. Amazing. So we have 2 truths. Amazing. We have 3 truths. Okay, amazing. The answer here is true. We're running through these because they are simple and we kind of know the gymnastic at this point, the dynamics. So if we say that the intercept of the SML is beta, the answer would be false. Amazing. Good. And then this one's interesting. So typically, one can argue that the beta of a portfolio is equal to the average of the beta of its individual stocks. What is the answer here? True or false? We got 1 false. We got 1 true. We got 2 truths. I need 1 more answer. We got false. Amazing. This is good. I like that. That means that we have some things to unpack. Okay. So the beta of a portfolio is what we could discuss as being beta P. Okay. Oh, sorry about that. My bad. I did. You're right. Sorry about that. I did not say the weighted average. Sorry. Sorry about that. That is my nuance. That is my nuance. Sorry. Yes. Typically, one could argue that the beta of the portfolio is equal to the weighted average of the beta of its individual stocks. And if that's the case, the answer would be true. But if it did not say the weighted average, then the answer would be false. Okay, that is an amazing nuance. Thank you so much. That just goes to prove that my dyslexia is working against me. Okay, so with that said, what I do want y'all to remember though, is that we could discuss the beta of a portfolio as we said, as being the weighted average of its betas. So I'm sure you've seen this definition. Okay. And essentially what this means is that we could discuss beta as being beta A times the weight of A plus beta B times the weight of B plus beta N times weight N, times weight N. So with that being said, we could do this to infinity, and with that, we'll be able to find the beta of our portfolio. Now, G, the expected rate of return must be equal to the required rate of return for the market to be in equilibrium. What is the answer here? True or false? We got one true. We got two trues. I need one more answer. Amazing. So yeah, the answer here is true. Okay. Now quickly, just for you guys to understand the nuance, we know that this is our SML. And we understand that the following point, okay, right here, be our ERM. And we know that for this to be in equilibrium, it has to move towards the SML, okay? So that's essentially our point here, okay? So the expected rate of return must be equal to the required rate of return for the market to be in equilibrium. And under the SML, we're saying that if something is, as we said before, if it's underpriced or if it's overpriced, the market is going to put pressure for it such that, the required rate of return is equal to the expected rate of return in the market. Okay, so that's the idea of the SML. There's going to be pressure towards getting this stock, getting this security as being fairly valued rather than underpriced or overpriced. So with that said, we can move to a few different questions that are super straightforward really quickly. We're going to move through these quickly because I do want to get to the math questions, but we are moving through the following pretty fast. So the market risk premium is only the percentage of the portfolio consisting of risk-free assets divided by the percentage of the portfolio consisting of risky assets. The answer here is definitely false. We know that the market risk premium is equal to ERM minus RF, okay? So for that reason, this is what we call false. Amazing. Now, the market risk premium is the slope of the security market line, okay? And the difference between the expected rate of return from the market portfolio and the expected rate of return from the risk-free asset. The answer here is amazing. Good stuff. Okay. I need two more people to answer that did not answer as of yet. So maybe we got true. Okay, we'll ask one more person. Sarabjot, what do you think the answer is? Just for fun. I want to get you participating. I need to see some action. Amazing. Yes, the answer here is definitely true. We know that it's the slope of the SML, and we know that it's the difference of ERM and RF. So stocks with the same total risk can have different betas. Now, this is an interesting one. Stocks with the same total risk can have different betas. What is the answer here? Oh, there's pros. Nice. Nice. Okay, good. The answer here is true. And there's a lot of ways to look at this, but essentially, it's all mathematics. The market risk, right? The way I would look at this simply is that different portfolios, different stocks may have a different impact on the market variance, but still, like, they could have different risk, but they could still have the same impact to the market variance because of the proportion. And this is something that you're going to be looking at more in detail when you're going to be doing 385 and 395. But my point here is just going to make it super simple and very logical for you, is that there are about 68,000 stocks traded on the New York Stock Exchange. Okay, there are about 68,000 equities. Okay, it's impossible for them to not have the same level of betas for a certain amount of stocks. but inherently they will have different types of risk because they will have their own risk makeup that will essentially nature from the unique risk and the market risk that they're exposed to. All right. So you just want to look at this answer at a very logical perspective. There are 68,000 equities being traded. There's for sure going to be some that have the same total risk, but just different betas, different contribution to the market variance. Okay. For example, once again, I'll just make this clear again, is that I'll give you an example. Let's say we have stock AMC and then stock Apple. Okay. What's really interesting is because we know that market risk, okay, market risk is like a pie. And if you already have the answer, don't worry about this, but I do want to still take the time that we have now to put you in a good position for your other courses, okay? Market risk, essentially, you look at the larger companies in the market will have a bigger share of the market risk. Does everybody understand that? Larger companies, you know, like Apple, Microsoft, will have a bigger say on the market risk. Does that make sense? Right? Because they're the largest companies in the market. So whatever happens to them will impact market risk a little bit more than, let's say, your company or mine. Yeah, I think that's feasible. I think we're on the same page there. Okay. But what's interesting with this is, like, let's say this is Apple, right? But then AMC would have just a small share, actually even smaller than that, a small share like this. Okay. So let's say for whatever reason, they would have the same risk, but obviously their betas would be different because they would contribute to market variance differently, okay? And that's the real nuance of beta. It's sure you could have the same risk, sure you could have the same risk makeup, but the amount of the total market pie, the total pie will essentially fluctuate because Apple has a bigger portion of the market, therefore it will have a different beta. Okay, so that's just a different way to look at this. I'm just trying to give you more logical perspectives. So D, the slope of the CML is a market risk premium. What is the answer here? Come on. The slope of the CML is a market risk premium. Is that true or is that false? We got one false. We got false. Hell yeah. We know for sure that the CML has the Sharpe ratio as its a slope. So the slope of the SML will increase if the risk-free rate increases. The slope of the SML will increase if the risk-free rate increases. What is the answer here? I got one false, false, exactly. I need one more false. Okay, y'all are doing okay. The answer here is false, and it's pretty straightforward. If the SML is equal to the following, RF plus beta ERM minus RF, the slope will definitely not increase if the risk-free rate increases. The more the risk-free rate increases, the more the slope will decrease. It's just pure math, right? So it's pretty straightforward. Okay, so now we get to do the fun stuff. Now we get to lift some heavy weights, and that's where we're going to shine today. Okay. This is something that I saw on my exam too, and this is something that I saw on my final, okay? And this is something that you clearly see a lot in past exams, and I'm sure you've had the opportunity to look at a few past exams, okay? So understanding this is crucial, and we have quite some time, okay? So a portfolio has 10 stocks, all right? And it has a beta of 1.7, all right? So we're gonna call this we're going to call this BP. Okay. Security X represents 16%. Okay. And of the portfolio's weight, and security Y represents 18% of the portfolio's weight. So here we have weight X. We could also call it weight A just to make it simple for us because of all of our theory. You have weight Y. We could call this weight B just to make this very easy for us. So just to make it clear, security X, we're going to call it security A, and security B, we're going to call it security Y, we're going to call it security B, just for just to make it easier for us to go through this. Security X has a beta of 0.7, so that's really cool. So we know that beta X is equal to 0.7. You could also call it beta A if you want. And we know that beta B, so beta Y essentially, is equal to minus 0.7. We could also call this, this is just for, you could do this to your own comfort. It's really up to you how you decide to name your stuff. So we want to know right now, damn, Evan, you are fast. But what would be your new portfolio beta if you sell all of your investment in security X and Y in order to invest in the proceeds of the risk-free asset? Okay, so we want to know what happens if you eliminate X and Y. Okay, what happens if you eliminate X and Y? And then you're going to allocate all of that to the RF. Well, you need to remember that RF has a beta of what? What is the beta of RF? What is the beta of
0.
RF? 0, exactly. Okay. So me, when I do these questions, I really try to break it down into simple buckets. Okay. And this is something that I'm going to take the time to do because on the exam, I want to make sure that you know exactly what to do. So the answer here is definitely 1.714. Okay. And how we're going to do this is super simple. And for those of you who aren't too comfortable with this, it's going to be a great opportunity to understand how we solve this. So once again, we know that the beta of a portfolio is equal to the sum of the weighted, is equal to the weighted average of its portfolios, essentially. Okay. So in this case, we could say that to make this like super easy for us, we know that we have 10 stocks, okay, from which we know we have 10 stocks. And we know 2 stocks that we know. And obviously there are 8 stocks that we're not too sure about. So in other words, the way we could define this, if we want to make this simple, we could also then say that the beta of our portfolio is equal to, essentially, as I said, we're going to do weight A times beta A plus weight B times beta B plus all the different weights. So 1 minus weight A minus weight B. So essentially whatever's left of the portfolio times a beta that we don't know, right? We don't know what this value is right here. We don't know what the remainder of the portfolio is multiplied by in terms of its beta. That's like an unknown. And because it's unknown, like what we did in high school, we're going to call that X. Okay. In order to like stop using letters that could be confusing, we could redefine this as oh yeah, sorry, my bad. Thank you. There you go. Good. Thank you. That was a little typo. So now we know that the beta of the portfolio is equal to 1.7. We know that the weight of A in this case, right? The weight of the portfolio we're going to call A or X is equal to 0.16. And we know that that times its beta of 0.7. Okay, so we have 0.16 times 0.7. Then we're going to look at the weight of B, essentially security Y, and we're going to look also at its beta. So we know it has essentially the following, a weight of 0.18. You know that that's time minus 0.7, if I'm not mistaken. Let me just go back to make sure that I'm not completely fooled. So, okay, so now we have the 2 first elements, right? We have this bucket, we have this bucket. In order to find our remainder, can somebody tell me what would be the weight of the remainder of the portfolio? What is left from a portfolio after 16% and 18%? Amazing, we have 0.66, exactly. So then we have 0.66x. Okay, cool. So can somebody tell me what's 0.16 times 0.7? Can somebody tell me what 0.16 times 0.7 is all about? We're going to break it down to simple pieces. Nice. 0.112. And then can somebody tell me what 0.18 times 0.7 minus 0.7 is equal to? Exactly. Okay. And we know that that's plus 0.66x. Now, somebody other than Alex can tell me what 0.112 plus minus 0.126 is equal to. And honestly, everybody that got to 2.6, I have exactly what your mistake was, and I'm going to tell you what it was in just a second. Okay, so can somebody tell me what 0.112 plus, thank you so much, Tierno. Amazing. Thank you. All right, so we have that. Wait, 0.14, yes, that's correct. Okay, plus 0.66x. Now I'm going to ask you to solve for x. What is our x here? Can somebody tell me what our x is? What is our x? And I'm actually going to ask Raquel, and who else gave me 2.6? And Alex. What is our x? 2.6, right? Is 2.6 our x? Does that make sense? Or can we all agree that 2.6 is our x? Yeah, okay, amazing. We could all agree that 2.6 is our x. But this is super crucial, okay? Put this in purple there. Like, our x is actually not, okay? Our x is not our new beta. Our x is equal to the remainder, okay? It's equal to the remainder of our portfolio. It's the remainder of, it's like the beta remainder. It's what's left, okay? So 66% of our portfolio is beta. Equals to 2.6, okay? But that's not the answer we want. We want to know what happens when we allocate 34% of our beta, of our portfolio, to a RF, to the risk-free rate, that has beta 0, okay? Because we understand that now this element right here, we know that our betas will be equal to 0. This now will be equal to 0, okay? Such that our calculation will be slightly different. This leads us to a calculation to find the total beta of our portfolio will be equal to now this. Will be equal to beta P is equal to 0.34 times beta of the RF plus 0.66 times 2.6. Well, in this case, to be even more like specific, we're going to call it 2.59, 697. Okay. So can somebody tell me what 0.34 times the beta of the risk-free rate is equal to? What is that equal to? 0.34% to a beta of the risk-free rate. Is that going to give us an amount? Exactly. That's equal to 0 plus 0.66 times 2.59. And I'll explain, but just can somebody tell me what 0.66 times 2.6 or 2.59 is equal to? Nice, amazing. Exactly. So the way we're going to look at this, and it's fairly simple for those who are confused and who didn't really see what we did here, okay? What I want to do is separate our question or our solution into buckets. The first thing that we had to do, okay, the first thing that we had to do was essentially find what the calculation for beta is, okay? We know that beta is equal to the following, right? And actually, I'll make it into a circle, I'll make it easier, okay? Okay. So we have security A, we have security B, then we have the rest. Okay, so this is beta. And this is beta at the very beginning when it's equal to 1.7. Right? And we know that beta A is equal to 0.7. We know that beta B is equal to minus 0.7. Okay, that's what we knew. But now we want to figure out, well, what happens if we take, all right, all of this portion of our pie and we invest it into something that has a beta of 0, all right, such that 0.7 and minus 0.7 will not affect the beta of our portfolio as much, all right? So now we need to look at the new case in which we have our pie, in which all of this is allocated to the risk-free and the rest remains. Okay, so now this element will have a beta equal to 0, and this will remain to have its beta of 2.6, such that now our weighted average. Okay, so Raquel, what's your question? You can maybe ask me and I can give you a different perspective.
I'm just confused why we did the first step.
Like here?
Yeah.
Okay, so perfect. So just keep your mic open. So in the first scenario, like when we began our question, can you agree that we have a portfolio of 10 stocks?
Yeah.
Yeah, and then we have security A and security B.
Mhm.
And they have, beta A, which is 0.7, and beta B, which is minus 0.7. But we didn't know what was the beta of the rest of our portfolio, right?
Yeah.
So what we did is we wanted to find what was the beta of the rest of our portfolio, because we knew the beta of the portfolio, which was 1.7, but we didn't know what was the beta of the remainder. Does that make sense?
Yeah.
Exactly. So when we executed this function, we were able to figure out what was the beta of what was left in our portfolio, which was 2.6. Yeah? Like this portion right here is beta equals 2.6, because we want to know, well, what happens to the total beta of the portfolio if we take these two and put it into a risk-free rate, which has a beta of 0. And that's going to affect the total beta of the portfolio, yeah?
Yeah.
Exactly. So that's why we had to do the first step, because once we know this, we're able to compute the beta of the new portfolio, right? 2.59 and 2.6.
Yeah, but like Evan said, couldn't you just do the beta of the whole portfolio minus the weighted average times the beta of the first one plus, well, I guess minus the weighted average of the second times the first.
The way I do this one is because it's a more complete solution. Because when you have different types of questions that may require additional steps or segment it into several different securities, because for example, we could have A, B, C, and D, bunch of different securities. This just allows you to break it down a little bit in a more simple way. It's easier to understand for most. But if you have a different way of going about it, then that works too, 100%.
Okay, thank you.
No problem, no problem. Okay. So I'm assuming, Evan, you're just gonna share your perspective. You could definitely go for it if you want, but that's just one way of going about it in a simple and clear and easy way. So
yeah, it was just my way was just kind of a shortcut, because you're not actually looking for the beta of C and onwards. You just want the beta of X. You just want the new portfolio beta. So really all you need to do is take the original portfolio beta and subtract the portfolio betas that you're selling, and then you add the new risk-free portfolio betas, except of course, because they're risk-free, their betas are 0. So it's minus the old betas plus the new betas, which are just 0 times. Hence, you wouldn't even, it's as simple as the original portfolio beta minus the old portfolio beta times weight.
that's true, 100%. That's true. It's definitely a way to skip to the last answer. That's actually facts. I'm not gonna lie.
it honestly really confused me at first, but then I just
Exactly.
did it a few more times until I drilled it into my head like
Yeah,
a
no.
nail over cardboard.
It actually does make sense, 100%. So those are two ways of going about it. Those are interesting. And with that said, let's move on to question 10. Let me just see something. Let's go there. Okay, yeah. Okay, perfect. So really quickly, question 10 is something that I saw on my exam for midterm 2. It was fairly simple, very easy, but a lot of students tend to overlook what alpha is all about. So before we begin, let me just give you the formula for alpha. I'm sure you already have it, but this allows you to answer these questions super easily. All right. Now, if you use this formula, you find your answer in 2 seconds. So all that you want to do here is you want to be able to identify the different elements that relate to your expected return, your risk-free rate, beta, the market risk, the market return. You'll be able to find alpha, okay? So within this question, I'm going to ask you to tell me with these different prompts, what is the answer? What is alpha? What is alpha of stock A, okay? If we know that the market price is $21.65 per share, the annual return of stock A is 12% and 9% for the market. The market portfolio has a return of 12% and the stock A has a return of 9%. The risk-free rate is 2% and the company's beta is 1. With all these different factors, what will be our answer for alpha? With this formula, I'll give you all like 2 minutes, a minute actually. It's pretty straightforward. You just want to know how to use this formula. It's very easy. We got one answer. We got one answer. %. It's like very probable that you did not cover alpha in class, and like that they ran over it. Like this is something that they don't spend a lot of time on, even in notes. That's why I'm taking the time to share it with you, because I seen this on my exam and I was like, huh? Thank God I had my notes. Exactly. I know. I had this on my exam and I looked at my cheat sheet and I was like, thank God I wrote that down. So that's why it's important to have this in your back pocket just in case. Really crucial. Really, really, really crucial. Okay. So let me show you how we go about it. All right. So the first thing to do is we need to understand our formula. Okay. In our formula, we have this factor. We have this factor. We have this factor, and we have this factor. There are 4 different elements that we need. Okay, so what we want to do is we want to identify these 4 different elements within our question. So we know that the expected return of A is equal to 9%, right? The market portfolio is equal to 12%, and the stock A is equal to 9%. We know that the ERM is equal to 12%. They tell us that the risk-free rate is equal to 2%. And we know that beta is equal to 1. All right. And now that you have all this information, it really becomes super simple. All that you have to do is just add this in within the formula and you get your answers. So you have essentially 9% minus 2% minus 1 times 12% minus 2%. Okay, so here you have 9 minus 2%, which is going to give you 7%. And here you have 10%, such that you have minus 3%. It's as simple as that, and that's how you find alpha. You just have to go through it one by one, and you get, oh, they gave you that just to scare you. Yeah, 100%, 100%. That's how to do it. You want to know that alpha, like realistically, I'll give you the quick rundown. I don't want to spend too much time on that because we have an hour left and I want to go through options and market efficiency. But really how it works, you have your SML. If K is over here, if the expected return is over here, this section right here is called alpha. Alpha is essentially whatever's over the expected return on the market, right? So that's why a lot of companies and hedge funds, and if you're trying to work into finance, you're going to hear this word alpha a lot, right? Alpha and beta are some very, very common words. So that's why pricing doesn't really matter here. You're really looking at percentages, okay? So with this question is fairly easy. Let me just see. We could spend 2 seconds on it. It's very, very simple. The ABC company has a beta of 0.8, expected return of 9%. The market risk premium is 9%, and the risk-free is 2%. Okay. With all this information, can you tell me what is the correct answer? We have Alex with C, who's saying that the asset is underpriced according to the CAPM because its return lies above the SML. Okay. We have a lot of C's. Amazing. We have Tierno with C. One more person with an answer, just for fun, just to see, no pun intended, what y'all think. Okay, cool. So the first element here, and we've covered this quite in detail at this point, but we want to find, based on the different elements given to us, what's our K, okay? What would be, at that specific beta point, what would be the expected return, essentially, all right? What would be the value here? So you do RF plus beta, ERM minus RF. So then you would have 2% plus 0.8 times ERM, the expected return, which is 0.87, if I'm not mistaken. 7%, sorry about that. And that's going to give you 7.6%. However, you know that we're looking at 9%. 9% is the expected return. So if the expected return is 9%, okay, the expected return is 9%, that is well above the 7.6% that is expected. That is like required, okay? And for that reason, the asset is underpriced according to the CAPM because its return lies above the SML. And that's simple as that. I'm kind of running through these questions because at this specific point, you understand the theory, and we've done quite a few questions. But I do want to spend quite some time on market efficiency, and we have about 15 minutes left. Okay, so before we begin in market efficiency, we're going to do this in inverse. We're going to begin with a question focused on options, because options is something that I'm sure all of you overlooked, and it's something that is really easy to understand, but we need to apply the time required. Okay, so we're going to jump into options and then do market efficiency. And you're going to see why this is actually something that, you know, it goes well. It's a pretty fun experience. Okay. So let's check this out. So we're going to dive in this long question for options. All right. Okay. Is everybody okay with options? Did you study it a lot? How do y'all feel about options before we start? About this idea of payoff diagrams? I want to know. This is really interesting. Okay, we got good. That's not bad. Okay, how about somebody else? Kind of quickly, I want to know what's the survey of the group. Not bad. Okay, perfect. What I'm going to give you now is literally the best way to go about it in like 2 seconds. It's pretty straightforward. It's really fun. All right, so let me do that. I'm just going to open this real quick. All right. So with this, I'm going to give y'all the really the best way to break down these questions and to really do it in an effective method. Okay. But before we begin, I will spend some time to say that a put and a call are essentially different types of options that we could exercise. Okay. A put is the right to sell a stock at a specific price for a specific time period. I'm gonna say this one more time. It would be nice if you could write it down or just, review this later. A put is the right to sell a stock at a specific price for a specific time period, okay? Whereas a call is the right to purchase a stock at a specific price for a specific period of time. I'm gonna be annoying and I'm gonna say it one more time. A call is the right to purchase a stock at a specific price for a specific amount of time. It's really important that you understand this because then you'll be able to break down these questions, and there will be a question like this in a quick and effective way. Now, still, I'm going to break this down into steps, but I'm sure y'all are so quick and so good, it won't be a problem at all. Okay. So with that said, suppose that the price of a share of a stock is currently trading at $30. Is that important? Who knows? Okay. And we're giving you 3 different option positions that we are going to buy or sell. Okay. So the first one says we're going to buy a call option with a strike price of $25. The second one says that we're going to sell 2 call options, each with a strike price of $40. And the third option says that we're going to buy a call option with a strike price of $55. Cool stuff. Amazing. But now we're asking you to draw a payoff diagram of this portfolio. But now this leaves us to think, how the hell do I build a payoff diagram? How do I do this? How can I become an amazing pro at this specific thing? It's a pretty nuanced concept. So I'm going to give you the clear, easy way to build a payoff diagram. I really do suggest that you follow these steps and really practice them before the exam, such that you're comfortable to identify what it's all about. And you're going to see how this relates to what you've seen in your notes, although really ugly in your notes. So we're going to build a table, and I encourage all of you to build this table with me. All right. Oh, it's terrible. Okay. And the first portion of our table will be what we call our positions. Okay. Our positions, obviously, is what we've discussed right here. I really, really, really do encourage y'all to do this with me if you can. It would be just beneficial for you. Okay. And now when we look at our positions, can we all agree that we have 3 positions? The first one in which we buy a call, the second one when we sell 2 calls, and then we buy a call again. Okay. So we have 3 different types of positions. For simplicity, we're going to call this position A, position B, and position C. Alrighty. And we're going to try to plot these 3 onto our positions table. All right. So on our positions table, so we have position A, we have position C, position C, B and C. Sorry about that. So here is we buy a call. Okay, at $25. Here's we sell 2 calls at $40. Then the last one is we buy a call at $55. Of course, the answer is not that actually. Of course, and that's why it's really important to break this down into simple steps, because honestly, when I studied for this, even like my prof was a PhD, and even him, he was like, listen, I use a payoff diagram, and I've been doing this for years. So it's really important to take the time to do it. Obviously, you don't have to make it as pretty as this. Obviously, you don't have to take the time to write down their titles, but just because I want you to review this in a simple and easy way later, I think this is optimal. So with that said, we have our 3 different positions. Now, when we want to build our payoff diagram, we need to look at different scenarios, different possibilities, okay? So in order to identify these different possibilities in our payoff diagram, we need to just look at essentially I'll call it 140. Well, we need to look at 6 prices. We need to look at 6 scenarios, or essentially just a bunch of different scenarios. We need to look at extreme scenarios, and then we need to look at the scenarios given in our prompts, the prices given in our prompt. So we have a price at $25, $40, and $55, as well as a $30 per share. So what we're going to do is we're going to see how valuable our options are at all these different prices. Okay. But we also need to look at extreme scenarios. For example, $0 or at, the double of the median or the median. Or we need to look at, Q1 plus Q4. You'll see what I mean in 2 seconds. So how we would do this is we would look at what would happen if the price was $0. What would happen if the market price was $25? What would happen if the price was $30? And I'll tell you why in 2 seconds, and you'll see it. It'll be super easy. What would happen if the price was $40? What would happen if the price was $55? Then what would happen if the price was $80? Then here we don't care. We'll write this as notes. Although we don't need those. Okay, so now you're probably asking yourself, why the hell do we use these prices? What are so interesting about these prices? So as you can notice, all of these different prices, all 4 of these prices were provided in the prompt. You see $25, you see $30, you see $40, and you see $55. On an exam, you want to understand what would be the payoff on these different positions based on the prices provided to you. That's the most logical part. But you also want to see what would be the payoff in extreme scenarios. Now you may ask yourself, how do we pick extreme scenarios? And I'm going to write this down just for it to be super obvious. This is an extreme scenario, okay? And then, of course, these scenarios are given. Okay. So why did you choose $0? Is because you want to look at a crazy scenario in which, the stock is trading at $0. But then you also want to look at an extreme, right-hand scenario. The way I do this is either I do 40 times 2. Okay. So I do our median times 2 to find my extreme, or I just do the smallest amount given in the scenario plus the biggest amount given in the scenario, right? So you could do 40 times 2 to get 80, or you could do 55 plus 25 to get 80. It's really up to you. There's just 2 different scenarios to find your extremes, okay? So now that we have that, do we have any questions before we begin? Or is this all good with everybody? Do we follow? Do you have your table? Are we happy? No, everything's good? I assume, yeah.
Yeah, I was thinking, so to find the values in each case, right? I assume because this is a call option, we would have to do the payoff, find the intrinsic value of S minus X, right?
I'll show you in a simple way. All right, so everybody check this out. So now we need to remember one thing. We know that a call is the right to purchase a stock at a specific price for a specific amount of time. So assuming we buy a call at $25, okay? So we're allowed to buy something at $25. Let me ask you, my rational friends, if the stock is trading at $0, are you going to offer yourself to pay $25 for it? Yes or no? Just tell me right now. Yes. If the stock, you would not pay for it at $25. You're not going to exercise that right. It would make no sense. Okay. So here, naturally, our payoff would be $0 because we're making no savings. We're losing money at that point. All right. So we're making no savings. All right. Now, if the stock was selling at $25 in the market and we have an option to buy it at $25, are we going to use our option? Tell me, what are we going to do? Are we going to use it? Is it going to give us anything? The answer is no. We're not going to save money. We're not going to make money. It's whatever. Okay. So our payoff is equal to $0. But what if the stock price is trading at $30, but we have an exercise option at 25? Would we use our option? It's trading at $30, but we're allowed to buy it at $25. Huh? That's not bad. That's pretty cool. So would we exercise this option? I just see one yes in the chat. I need to see if you guys understand. If it's trading at $30 in the market, but we could buy it for 25, for sure we're going to exercise our option. So what would be our payoff in that scenario? How much money would we be saving or making? How much? $5. Yes, amazing. So our payoff would be $5. What if the stock, the price on the market was equal to $40? How much money would we be saving or making? I need one more answer, just for fun. Amazing. 15. And then what if it was 55? I need one more answer, just for fun. 30. Yes. And what if it was 80? What if it was 80? How much money would we be saving? I see one answer. We could buy the stock at $25, but it's selling at $80. How much money are we saving? Hell yeah. Okay. Okay, cool. This is really cool. All right. This is amazing, actually. So let's look at a different scenario. Let's look at what happens if we sell two call options. Okay. Now, selling is an interesting nuance. It's where we need to apply a little bit of logic. All right. Selling essentially means that we're losing the opportunity to exercise our option. If you sell something, like if you sell your home, you're literally losing the opportunity to sleep in that home. If you sell an option, you're losing the opportunity to exercise that option. If you sell your computer, you're losing the opportunity to use your computer. Okay, so just use that as a point of reference. So before all that though, if the stock price is $0 and you have an option at $40, how much money would we be making then? How much money would you be saving if the price in the market is equal to $0, but you have an option at $40? Amazing. Okay, how much money would you be saving if you have an option at $40, but the stock is trading at $25? I need one more person to tell me an amount, just for fun. One more person. Moichido, uno, Wahed. There you go, $0. What about if the what if the market price was $30? Would we be making money, saving money? What's up? Okay, cool. I think we're all on the same page. Okay, cool. And at $40, how much? What about $40? Huh? Are we making money? Are we saving money? What's going on here? Yeah, $0. I'm working with some pros right now. Okay, so what about $55? Okay, if we have an option at $40, okay, we have an option at $40. Let's say we still had the option. We had the option at $40 and the stock is selling at $55 on the market. If we still had it, how much money would we be making? I just want you to answer the first question. If we still had the stock, okay, we still had the option of buying it at $40 and the stock was trading at $55, how much money would we be making? $15, right? $15. But we have two options, right? How much would we be making then if it's twice? $30, okay? But we don't have those options. We sold them. So how much opportunity or money could we have made? We lost $30. We lost the opportunity of making $30, okay? So in this case, I would write, we would make 15, that times 2, 30. But because we know it's a minus, we're losing that opportunity. It's minus 30 that we have here, okay? You can find a bunch of different ways to rationalize this for you, but when you're selling a call option that was gonna make you some money, let me say this one more time. When you're selling a call option that could have made you some money, you need to look at that as a loss in your payoff diagram. Okay? When you sell an option that could have made you some money, you must look at that as a loss on your payoff diagram, essentially your payoff table. And that's why our value here is minus 30. Okay? Once again, I'm gonna say this one more time just to be annoying. We know we could have made $15 if we had this option. We know that we had two options, therefore we would have made $30, but because we sold it, we lost the opportunity of making $30, and that's why our value here is minus 30. Now, can you do the same gymnastic for $80? How much did we lose at $80? How much did we lose here? What am I going to put here? How much did we lose? The stock market, I mean, the price on the market is $80. We have an option at 40 bucks. Maybe, I don't know. What do y'all think? Is it minus 40 times 2? I see 2 answers. Okay. Amazing. Hell yeah. There you go. Minus 80. Amazing. Really, really good. So now, finally, let's look at if we bought a call option at with an exercise price of $55. Okay. Now y'all are pros. At $0, are we making money or not? Amazing. What about $25? Amazing. What about $30? Amazing. What about $40? Amazing. What about 55? There you go. And what about 80? How much money are we making at 80 at $55? There you go. Amazing. Good. Okay. So now we have all of our different scenarios. And like any other table in life ever, we're just going to sum all of our values in those columns. Okay. So we're going to look at our total. Look at our total. Total payoff. So for the first column, okay, what is our payoff for the first column? We have $0. Okay, amazing. What about the second column? $0. What about the third column? $5. What about the fourth column? What about this one? What's going on over here? 15. Amazing. What's going at 55? Amazing. What's going on at 80? Amazing. So let me ask you a really good question. What's the best place to exercise our option? What's the optimal scenario? At what price point? There you go. Amazing. Yes. Exactly. This is the optimal case. This is an optimal case. Amazing. You are all so good. Okay. Now, before we stop with this question, let me just further this to a certain degree. And this is going to be important because it's going to allow you to really understand these weird theory questions they're going to throw at you for options. And you, instead of trying to only memorize them by heart, why not try to understand them? Okay. So let's try to visualize this from a really strong perspective. Okay. So let's say we have all right. So we're going to call this our market price, our horizontal axis. We're going to call this our payoff. Does this make sense? Yeah, this should make sense. Okay. So what we're going to do on our horizontal axis, we're just going to add all the prices that we had here. So 0, 25, 30, 40, and 55, and 80. Okay. So we have 0 right here. We're going to put 25 here. Put 30 here. And put 40 here. Put 55 here. I'm going to put 80 here. Okay, as our market price. Then we're going to put our payoffs a little bit all over the place. Okay, so we had payoffs that ranged, we'll give a few amounts. We had what, if I look at this quickly, we had 0, 5, 30, 55, 25. Okay. So what I want to do right now is just show, based on the different like lines that we have, the different positions, how we would try to draw this actual option. Okay. So if we look at the blue, oh my God, if we look at the burgundy color, we know that this option becomes profitable starting $30 from our scenario. Okay. So we know that essentially our option does not give us any payoff up until, does that make sense? Up until 25, sorry about that. Up until $25. Okay. But then we know that here, it seems to make a little bit of money, $5. And then just because we're losers, we're going to continue like this. Right, 55. Okay. So this is how we would draw our option. We know that at $30, it's making $5, and we know that at $80, it's making us about $55. It makes sense. Okay. The same thing could be applied for our orange line. All right. We know that that one's not going to make us any money, but because we want to look at it just from if we still had it, we could say that at $55, it's going to make us $30. Okay. So from that same vein, we could go like this. 5 makes us $5. Just show 16. Right. And now you understand the perspective is that we could draw all of our different lines in different ways to represent the scenario given to us. Right. So we have all these different options that could be drawn onto our payoff diagram. But we could also draw a payoff diagram as a different way with our green line. Because we could look at all of our different positions, which is position A, B, and C, and try to see, well, where do we actually make money? Right now, we knew that the market price, the best market price is going to give us the most payoff is at $40. Okay, so right here, we have the best. Okay, and right here, we have about $5. We could also assume the following. Such that if you had to draw a payoff diagram, it would look like this concerning all your positions. Now, I'm sure on your notes, you saw payoff diagrams as follows with this type of like look. And that's why. It's because when you look at all your different positions, you get to something like this. Okay. I just tried to make this visual. Okay. I just try to make this something visual such that you could understand what it means on your notes when you're trying to review them the night before your exam. This will allow you to have a different breadth of nuance when you study, okay? So before we stop with this question, did this make sense? Are we all okay with this? Does this help you a little bit better when you solve questions like this? I think this should be fine. Good, amazing. So now we're gonna work, no, the total payoff is not $5. The total payoff would be $15, right? Because at $40, that would be the best scenario. The best payoff would be $15. $30 is just something that they use to trick you. Like this is not the only scenario we're looking at. We're looking at every single scenario. And what this does here is that this makes it obvious to us that the optimal payoff is at $40, right? The optimal payoff, the point at which we're making the most money is if the market price is at $40. It's not $30, it's not 55 nor 25, whatever. All right, Raquel, does that make sense? Okay, this is what we've had on our exams, and in my teacher as well kind of showed us this when we took Comp 308. A payoff diagram, you really look at all the different scenarios provided to you, all the different pricings, and you just see what will be your payoff in all those scenarios. And then from there, you get your total payoff. And this shows that at $40, you have your optimal point. Perhaps, Raquel, you can send me like a messenger, like a messenger thing, and I'll check it out. But this is typically the best approach. Now, Sarabjot, so the definition of a put, okay? The definition of a put is the right to sell a stock at a specific price at a specific time. The right to put is the right to sell a stock at a specific price at a specific time. All right. So with that said, what I want y'all to know is essentially, let me see if I have the answers to this. What I want y'all to know is I want y'all to write this in your notes, okay? There's no other way to go about this. My biggest weakness is options, honestly. And when you look at everything, and the way I use to like master these theory questions that they throw at you in the exam is to literally just write the definitions, okay? And this is a multiple choice in which you have the answer. Just write the answer onto your cheat sheet, and when they throw at you this in the exam, you know exactly what the answers are. All right. If I were you, when you see a question like this, okay, in which it says an increase in which of the following will increase the value of a call option, what I would do if I were you, I would do as follows. Okay. For your notes, by the way, for your notes, not for answering the question, just for your notes. I would say call option. Jeez, can't even write. Call option. And then here I would put increase. Decrease. I'd make a little table essentially. And then I would have a bunch of different like items. And I would say increase, decrease, increase, decrease. Such that on the exam, when you have a question similar to this, you'll be able to just be like, okay, according to my table, this is the answer. It took you 10 seconds. That's the best way to go about it, okay? But in this case, I already have the answers for you. I made it for you such that, you know, it's easy. In this case, the following that actually increases the value of a call option would be the answer B, okay? So the answer B says that interest rates increase the value of a call option, the variance of the return of the underlying asset, and time to expiration, okay? And if I were you, you could also put like a none of the above, okay? And that would be the best way to solve these types of questions. So for example, here you would put like interest rates. And you would say in your notes, yes. You would put variance. You would put yes. You would look at time to expiration, to mature. You would put yes. That's how I would go about it. That's how you optimize your odds. For this, I just can't give you as much theory just because it's actually way beyond Comp 308. But this is a really good tactic of making sure you have this, you know, written down and easy for you on the exam.
I have a question.
What's up, man?
For interest rates, let's say if they increase, would that increase the put options?
Honestly, I would, let me see. I have the answer here. I'm Biroshu, I'm not the expert when it comes to like call options and put options. That's why I would say take the answers that I have from my book and really go from there, because these things is where I struggle the most. I'm not gonna lie. That's why really going about it would be the best. And any of the ones specific in this place, I would put dividend payments as something that's like none of the above in current market theory. Although in like value pricing, they may put dividends as something that, no, dividends as none of the above. Interest rates, variance, and then time to expiration is as increases. Okay. What's up?
An
Evan?
increase in dividends decreases call option value and increases put option value.
I mean, if that's what you have in your notes, that kind of differs though, because in current market theory, that doesn't really like work and fin 395, that's what we explained. Dividend payments actually have no effect on the value of an underlying asset. So by that definition, it would have no effect on like its call or its puts. But that's why, you know, this is not my bread and butter. That's why I give you guys the answers, and I would say make your best notes from there. That'd be the best way to really hedge yourself for the exam.
Would the increase in interest rates be count as an increase in stock price? Like, are those connected?
Not necessarily in the stock price, but definitely in your call options, because you would use interest rates as a way to define how you would essentially value that option.
Okay.
Yeah. Basically throw it out the window after 308. In this case, for this question, once again, I'm going to give you the answer. Other things equal, the price of a stock of a call option, it will be positively correlated with the following factors. So the answer here is all of the above. Okay. I'm kind of running through them as well because I want to jump into market efficiency because we have 19 minutes. But all of the above would be the answer. And then, as I said before, the best way to go about it is to put increase, decrease, and none of the above. And then here you would say, okay, well, interest rates, we already know the answer. It's not there, but you would say that. The stock price will increase the value of a call option. So you'd put stock price here. You'd say yes. You would say time to expiration, we already know. The volatility, we already know. But you could also put RF as a yes. So all these factors will increase the value, okay, of a call option. All right. And then this one, let me find it for you right now. I have it in my notes. The value of a put option. This one I actually don't have it in my notes, but essentially it would be typically the inverse of the other. So the value of a put option, typically it could decrease when one is not correct. The risk of return decreases could be correct, and the volatility of the underlying prices decreases is correct as well. So from there, C is the right answer, in my honest opinion. But once again, I'm not the best with call options. I'll put a note for this, but I do want to jump into market efficiency because we have about 4 questions on that element. All right. So with that said, I want to make sure that we go through everything. So before we begin in market efficiency, okay? Before we begin, I want to ask y'all, are you guys kind of okay with market efficiency? How many questions have you done on market efficiency? Because this is going to really allow me to create this model that I have for you. And once again, this is also in the notes that I've sent out, okay? You spent a good amount with market efficiency. Now, with that said, market efficiency, I really see it as like an umbrella, as something like something where every single element carries over. We could look at this as a pyramid, like a foundation where we stack over, or we could look at it as like a Russian model, those Russian like dolls. But the best way to look at this is the following, okay? So market efficiency, we know that we have 3 forms, right? We have strong form, we have semi-strong, and we have the weak form. And what we're going to do now is we're just going to build like a proxy model. And then we're going to say nothing. Okay, we're going to look at nothing. Okay. So when we look at these 4 different models at the strong form, the semi-strong form of market efficiency, and at the weak form of market efficiency, and at no form of market efficiency, we're just going to try to see if these elements hold. Okay. So the first thing to understand is that we know we have 3 forms of market efficiency. Once again, I think that we're all okay with that. But what we want to notice is that, well, we have 3 different umbrellas or 3 different elements that we need to essentially allocate to these different forms based on their subject. So how we're going to do this is as follows. We're going to build a little table together. Okay. Okay, we're gonna build a little table together. We'll look at a few different concepts. So let me ask you a quick, wow, those are the worst lines ever. Whatever, anyways. Let me ask you a quick question in the chat. What are the 3 different types of data that we look at when we discuss market efficiency? There are 3 different types of data that we discuss. So Yara says historical, public, and private. Amazing. So yes, there are 3 different types of data that we analyze. So we look at historical data. We look at public data. We look at private data. Okay, that's amazing. So with that said, what do we mean by we look at these 3 different types of data? Essentially, what we're saying under market efficiency theory is we're saying that depending on the form of market efficiency, the price will actually reflect these points of data. All right. And within this table, we're going to be able to say whether the stock price actually reflects one or all of these 3 different types of data. Okay. So for example, let's say we begin with weak form. So under weak form, what type of data is supposed to be reflected in the price? Can somebody write that in the chat? Okay, I got one saying historical. Is that true? I just have one person saying historical. I have Yara. Okay, Alexander says historical. Maybe another, just for fun. What type of data is reflected into the price under weak form market efficiency? The answer is yes, weak form, okay? So under weak form market efficiency, historical data is reflected onto the price. Now, when something is reflected into the price, it means that somebody could not make money or beat the market by looking at past prices. And that's due to this idea of the random walk. You know, the price yesterday does not affect the price today. But more importantly, what this means for weak form is that public data could be used to beat the market and private data could be used to beat the market, okay? So, no. So essentially as well, I'm just throwing a lot of different things that you're going to see when we do our practice problems, is that under weak form, it does not hold that public data cannot be used to beat the market. Under weak form, it does not hold that private data cannot be used to beat the market, okay? Now, under semi-strong form, what is reflected into the price? Under semi-strong form, what is reflected onto the price? So Cherno says public. Yes, there is public, but we need to remember that it's public and historical data, okay? So under semi-strong form, public and historical data is reflected onto the price, okay? So essentially what this means is that if you're investing or if you're trying to hedge the market in a semi-strong form, okay, under market efficiency theory, historical data, so past prices, cannot be used to beat the market. So you can't look at yesterday's price to beat today's market. And under semi-strong form, public data could not be analyzed to hedge, a really good position. That's impossible. However, under semi-strong form, you could use insider information to beat the market. Okay, so if the CEO comes to you and says, hey man, I'm gonna invest in this, that, you could use that to beat the market. Okay, now under strong form, what does that mean? I'm not gonna ask you, it's obvious. It means that historical data, public data, and private data is all reflected into the price of the market. Okay, so all of these are a yes. But now let's work backwards, okay? If strong form market efficiency holds, then we could say that nobody could beat the market by looking at past data. Nobody could beat the market by looking at public data, like a financial statement. Nobody could beat the market by looking at private data, so insider information, okay? Now onto the next bubble. Under semi-strong form, All right, we could say that people could beat the market by having insider information, but they cannot beat the market by looking at a financial statement or analyzing press releases or analyzing past prices. Okay, now on to the next bubble. Under weak form market efficiency, we could say that an individual could beat the market by having private information, by like Elon Musk, or by analyzing public data, such as press releases or financial statements, but they cannot beat the market by looking at historical prices, okay? But if no form of market efficiency holds, i.e. nothing, so this would be X, X, and X, then an investor could actually make money off historical data, public data, and private data, okay? So we have covered every single different element in this. But with that said, now I want us to look at some multiple choices that are directly related to this topic, okay? So let's look at this, all right? In the weak form of market efficiency, okay, then we can argue that stock prices reflect insider trading. Fundamental analysis isn't helpful. Trends in stock prices would be useful in selecting stocks. Insider information is the only tool that can help generate abnormal returns, and stock prices changes follow a random walk. What would be the answer here? What do you think? So we're looking at a weak form. Amazing. We got 2 answers at E. I need one more just for fun. I need one more answer. We have 2 answers at E. Amazing. Okay, so we have 2 answers at E. Really quickly, I just want to identify that yes, E is correct. But with that said, I want to kind of highlight a few elements that are pretty important. It's absolutely E. So random walk is exactly what relates to this idea of whatchamacallit, of the weak form, okay? And then also studying stock prices in the past essentially would violate this right here. I need to make it super clear that this would violate, okay? This would violate weak form. It would not hold true, okay? So for that reason, E is definitely the correct answer, because under weak form market efficiency, okay? Under weak form market efficiency, it is definitely true. And I would write that down in my notes as well, that stock prices changes follow a random walk, right? What do they mean by violate? It means like it breaks it, like it doesn't hold true. Like imagine your parent says, you're never gonna sneak out, but you snuck out, well, you violated the rule. Same thing applies with weak form and all that good stuff. So that's what they mean by violating a rule, or like not respecting a rule, okay? It's definitely an aggressive word, but it's something that they use sometimes. So consider the following scenarios, all right? Let's consider the following scenarios. You use a simple trading rule. You buy every stock that has gone up 3 days in a row, you hold the stock for 2 days, and then you sell. On average, you make an unusual profit. This is important. You make an unusual profit using this strategy. On average, analysts who analyze the financial reports of AMC do not make unusual profits using the strategy. Okay, so they analyze financial reports, but they do not make abnormal returns. So with that said, within the following statements, which one is most correct? And this one's really, really funny. Which one is most correct? So 1 is consistent with the weak form market efficiency, while 2 is consistent with the semi-strong form. I'm gonna let y'all read. Y'all could figure it out. So we got A and C. I need 2 more answers. I need 2 more answers. I need y'all to tell me what's up. I need 2 more answers. I have 1 at A and I have 1 at C. All right. A says that it is consistent with market efficiency, while 2 is consistent with semi-strong. C says that it's not consistent with weak form, and 2 is consistent with semi-strong form. I need 2 more answers. Okay, Monica says A. What about you, Sarabjot? What do you got? I need one more answer. Une autre réponse. Okay, so we have we're at a stalemate. We have 2 at A, we have 2 at C. So thank you so much for answering. Thank you so much for participating. The answer here is definitely C. But why is it C? Okay. What I noticed is that everybody is definitely on the ball. We're definitely looking at weak form and semi-strong form. However, we need to know which one violates which. So under weak form, let's make this really clear, is that under weak form, you cannot look at past prices. Okay, you're looking at trends right here. Can we agree that we're looking at a trend? You know, you're looking at 3 days and then you're holding for 2 days and then you're selling. But that would not work under random walk. Under random walk, you should not be able to look at the past. You cannot look at past and make unusual profits. That just does not work if we go back to our template. If you're looking at the past, if you're looking at historical data to beat the market, under weak form market efficiency, you should not be making money. You should not be making abnormal return. And for that reason, statement 1 is totally inconsistent with weak form market efficiency. Okay. But statement 2 makes it really obvious for us. You know, you're analyzing financial reports and you're not making unusual profits. That's exactly what the semi-strong form says. It says that if you're looking at public data, you should not be making money. Once again, the weak form says that if you're looking at historical data, you should not be making money. But why in statement 1 is he making more money? For that reason, that violates the weak form market efficiency. And for that reason, C is correct. So Alexander, Monica, is that okay? Like, are we cool with this? Does this make sense?
Yeah, I just didn't think of it as being historical data because to me that's like actual useful historical data, not.
Yeah, exactly. That's a nuance. 100% useful.
Oh, that's why like you can't actually do that. You know what I mean? Like if you say financial statements, you know, earnings, anything like that, then yes. But like a trend, like seriously, no. But anyways, yeah.
No, 100%. I mean, we're logical. We're like looking at this in a real life way, like, okay. But for them, this is really like looking at historical, looking at trends in the past and all that good stuff. And for that reason, it violates the weak form market efficiency.
Yeah, that's whack in my opinion, but yeah, okay.
We would not look at it that way. We're trying to make some money. We're not going to look at it that way. But, you know, JMSB, school, all that good stuff, they do it their way. Okay. So which of the following statements is most correct? All right. Semi-strong form market efficiency means that stock prices reflect all public information. An individual who has information about past stock prices should not be able to profit from this information in a weak form market efficiency. An individual who has inside information about publicly traded companies, blah, blah. Okay, so, you know, you guys are on the ball. Is it E? Is it A? Is it B? We have one answer. We have one answer. Which one of these statements is most correct? Request is E. Can I have one more answer just for fun? Une autre réponse. We have 2 people at E. I need one more answer. Okay, amazing. The answer here is definitely E. And the answer here is definitely E. This one's interesting though. I do want to definitely like kind of like talk about a nuance. B is cool because it's like kind of like nuanced because it says that an individual who has information about past stock prices should not be able to profit from this investment in a weak form efficient market. Like that's totally correct. Okay, that's like 100% right. And D saying that that would not be correct just makes it obvious that D is kind of is like D is like not enough, right? Like D is not enough for our answer. So E would be the most likely answer here. What I'm trying to say is that when you have things that are like blatantly obvious, you have to go with all of the above is correct. And for that reason, you guys were on the ball. I think that was just a lengthy way to just say bravo. But with that being said, our final question, the last question, okay? Which of the following statements is most correct? Semi-strong form market efficiency implies that all private and public information is rapidly incorporated into stock prices. We have B, by the way, D's right here. I'm sorry, it's a little typo. But we have a lot of people saying E. So are we saying that none of these are correct? Is that what I'm getting to? Interesting. So we're saying that none of these is correct. Well, I'm curious then. So what about C? What does C say? C says that weak form market efficiency implies that recent trends, I think we talked about trends a little bit, in stock prices would be of no use in selecting stocks. I think we did discuss trends. Trends, what are trends? Trends, in order to have a trend, you need to look at past data, right? You need to look at historical info. So maybe C, maybe C is okay. Maybe C is correct. C is definitely the right answer, right? C is definitely the most important, like the most correct answer, because yes, if you look at recent trends in stocks, like I need this to be super clear. This literally means historical data. And if you're looking at historical data and you're using that to make some money, that'd be wrong. But here it's telling you that historical data would be of no use. So that means that this is true. So C is definitely correct. Are we okay with that? A lot of people said E here. Are we okay with C? Does that make sense to all of us? Do not hesitate to ask a question by all means. We're good with this. This makes sense. I like Raquel, Sarabjot, Alexander. No, it's good. We're good with that. It makes sense. Okay, so that's actually the last question that we have in the crash. It's the last question. Question 19. Yeah. Oh, the actual answer? The actual answer is like 100% $15. The actual answer is 100% $15. And for 17, the answer is E. All right, the answer is E for 17. And then 16, we'll have to get back to y'all. I'm not gonna lie. I'm not 100% sure. I'm not gonna lie. I'm gonna have to get back to you. I'm gonna have to get back to you, Sarah, for 16. I have to get back to you.
For 16, I got D because I know that. Yeah, because I did the SOS crash, and they gave us a similar table that you gave us with call and the factors and what changes, blah blah blah.
Okay.
And apparently, according to them, if the underlying assets price increases, then the put option value decreases.
Okay.
Which lines up with
what we discussed.
This. Yeah. So there's that, and then after we don't have a risk rate of return. I guess that's just risk. Thing is, risk and volatility are the same thing, no?
Nah, because I'm assuming
like,
that's the thing. Like I kind of made this one off a whim back in the days, but I'm assuming it's risk-free rate of return decreases.
Oh, okay, that makes more sense because yeah, we have risk-free rate as well here. Okay.
The risk-free rate. But for 18, by the way, Miriam, I'm not sure if I didn't put it. For 18, the answer is B. Okay, 18, the answer is B. By the way, obviously, this is going to be given to all of you that attended. I mean, there's no other way to go about it. So you're going to have it. Everything that we've discussed, you're going to have. I'll actually save it now and I'll put it in the chat such that it's easy. I don't forget, you know. I'm going to put it in the chat right now. All right. So this is in the chat. In our member area on ISMA Helps, you're going to have the recording live, like right now. But just in case, as well as the PDF, but just in case it's in the chat right now, so feel free to download it. But with that said, that's pretty much the gist of it. That's pretty much the gist of it. Hopefully this was helpful to some extent. And yeah, it was always a pleasure. Love to help. More resources coming out within the next day or two, just for, you know, extra help. So I know you all are gonna kill it. Like the average is 75 for a reason. It goes up by 40% almost. You are gonna go up by 40% as well. There's no other way to go about it. All right. So a pleasure. Have a good one. Good evening. What's good, man? What's
you happy? Yo, everything's so new. I was looking at the website. I was like, oh shit.
Yeah. I'm expanding to all the schools in Canada. So I'm trying to
Shit.
do it now.
Yo,
Yeah.
that's gonna be so fucked.